What is going on, everybody? Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're a passive investor, maybe you're working in the multifamily industry, or maybe you're an aspiring multifamily investor, you're really trying to kind of figure out this whole thing out, or maybe you want to get into real estate investing, what's the right avenue? This is the best place to be in. On the Gray Report, we kind of recap everything that happened in the multifamily industry, real estate, and the economy, and really try to provide you kind of the latest, research, not just, updates and news articles, but kind of what is like the hard data? What are these research reports that are coming out all the time? We highlight them, kind of get into it, covering the macro and the micro. And, again, we're talking about inflation again. We're talking about employment. And of course, we're talking about, what is in the multifamily pipeline in terms of construction. A lot of stuff happened. You may not have caught it. So let's just get into it. All right, we're going to bring in Matt Bosnaga. Once again, he's the Director of Communications and Marketing here at Gray Capital. Matt, another excellent rendition of the Gray Report. Kind of the top headline is the Fed tapering in November. A lot of talk about that. Matt, what do you think about the Fed possibly tapering their buying of bonds and assets? How does that kind of relate to the multifamily industry, inflation? What's your take?
Yeah, and just in short, I think that it seems like, and they released their September 22nd minutes, and it's just as relevant today as it was when they were talking about it, 3 weeks ago or so. These minutes of that meeting mention tapering bond buying by the middle of next month, which could have an effect, especially now, but it also could correct this kind of inflation environment that we're seeing. In the broader economy, people are talking about inflation and stagflation, cooling growth, and broken supply chains. There's a lot of, and you look at on the Drudge Report headline, it talks about inflation and this skyrocketing price pressures that everyday people are seeing. And even though they continue to dampen CRE construction, which is more relevant for our industry, multifamily developers are working through these obstacles, and we'll talk about how they really are remaining actively building, which is both an encouraging sign that they're creating housing supply, but also a real good signifier of value value in multifamily as investments. So.
It's been fascinating the past couple of months, this past year. Matt, I'm just curious. We were talking about this a little bit before, and which is the conflict that the Federal Reserve has between kind of the two mandates that they have, which is stable prices and full employment. And we're going to get into some of the employment figures from the Marcus and Millichap piece that they put out recently. But what is the Fed going to do if they're seeing unemployment not hitting their metrics on where they want employment to go, but you see prices continuing to kind of get out of whack and spiral and really kind of get outside of their control, which was the concern. Do they have the appropriate tools? I mean, because raising interest rates would be the next thing they could do after tapering, and a lot of people think that could really can be a wrench in the gear for the economy. But is it like, that's a better alternative than really seeing this runaway inflation or whatever kind of, label you want to put on it?
Yeah, it is interesting. Throughout the pandemic, there was this emphasis on kind of getting the money out to people and getting the economy up and running. And with their kind of rolling average and the new way they calculate things, they're able to absorb a little bit maybe of inflation. But at what point does it start to become apparent that they're not getting the employment gains for the amount of work that they're doing? They've got these levers that they can pull, which, and we're talking about interest rates, and then also their bond buying. And tapering may be a more logical option now than really even it was in September 22nd. I don't like to see high interest rates, but if the alternative is higher inflation that is even worse for the economy, then it seems kind of logical. Specifically, the plan they mentioned involves and they could do this either November or December, cutting $10 billion a month in treasuries and $5 billion a month in mortgage-backed securities, with the goal of ending those purchases and returning to normal by the middle of next year. And I like they said normal. I don't know what normal is.
Yeah. Everyone's trying to figure that out today. And so, sorry, go ahead, Matt.
Well, and that's the thing, is like that connection between what is normal and between reality and like these abstract and not really abstract, between the levers that they're pulling, is really where discussions of stagflation start to get relevant, especially as it pertains to the Fed. So, like I said, what if they can do all these things, and what if it really doesn't affect employment as much, and you get a greater overall negative cost?
Yeah. And again, so that scenario, kind of stagflation of where, prices are still getting crazy, prices are rising, but, the workforce participation is low and just economic output and productivity is low. You could kind of see that happening, if prices don't somewhat, stabilize. But really, in terms of, tapering, the idea that we're still in using emergency, extreme emergency measures to that were originally meant to kind of prop up the housing market and the economy, when home prices in real estate in general are at all-time highs, and the stock market is, exceeded all-time highs, many multiple times, maybe not right now today, but we have, somewhat recently. And so, what's the need for all of this liquidity if things are running so hot? And that's not going to, that could rise some of those rates of some of those securities. And I think that might be the effect of the multifamily industry is, maybe we do see some slightly higher bond yields, but then it comes back to, this global chase and search for some kind of yield. And so as yields rise, you'd think there'd be all bond buyers. They're going to be lining up to purchase those securities if they are paying a higher rate, and then driving the rate back down. So I think we could see some higher financing rates for multifamily because of it. But, I think we shall see. And only cutting $5 billion of, mortgage-backed securities, MBS, that's not that much relative to what they're doing. They're doing like $60 billion a month right now. So, now doing 55, 50, 45, well, that's still a lot.
And I think it is the biggest uncertainty that I'm thinking of, and this is outside this Fed specific action, but it's trying to get where they're going is employment. And generally, if you're looking at a stagflation environment, there's some pain when it comes to people, trying to find work or not having, or, their wages not being able to support. But with such low labor participation that we have currently, and a labor shortage, it's really hard to see a parallel between, the kind of classic stagflationary environment.
Yeah.
I think that, and we've discussed this before, inflation is so complicated because these things are feeding back into each other. And so it's hard. And for me, at least, the question is, when is this idea of runaway inflation? Is this transient? Now, I've heard so many people talk about transient that that's the only constant.
I don't think. Well, no, I think now everyone's moving off, saying, okay, it's not transient. Like we've eclipsed the point of where it can be called transient, and now it's just, this is where we are right now. Now, I guess if we would have to see price leveling off, growth leveling off, just we would have had to have seen it, really call it transient. And, the definition of what is transient and what's not, I still believe, we're going to see higher prices on the medium term, probably not the long term. I think eventually we're going to shift back to slower growth, but no one ever expected what happened in the 70s to occur. And I just don't think that's going to happen with those kinds of rates, because the economy is different. But
yeah, well, and that's another thing too. The supply issues that we've had haven't been necessarily transient themselves. And so I'm waiting for a time.
And that's what's been unexpected is I think that most people, especially economists, the Fed, they're just assuming, okay, well, how long will it take to figure out these supply bottlenecks? And that's what they were asking themselves 6-8 months ago. And they would say, probably 6 months, to a year. And all of a sudden we're running into not just like we haven't figured out the original issues, but like we have new problems, and it's not getting better, because which a lot of it is now is being driven by It's being driven by, vaccines, people like dropping out the whole issue with pilots, or people, employees that, they don't want to get vaccinated for whatever reason that's causing issues. And then if people, involved the unemployment benefits, now they're just government programs that aren't incentivizing people to get back to work. All of a sudden there's no one to drive the trucks, no longshoremen, and we can't move things around. We all have a handful of anecdotes, how hard it is to, find employees, or, your restaurant with, one wait staff or whatever. That's what I think was unexpected. I think that they assumed the psychology of people and just human behavior wouldn't have changed that much, but I think it has. And so, Matt, I know we were going to cover that Bloomberg article. I feel like we covered a lot of it. Yeah. So I just want to move right to this Marcus and Millichap piece. Again, you guys, you can pop on over if you got the Gray Report newsletter, which you can sign up for at graycapitalllc.com/newsletter. Click on this button. If you just go to graycapitalllc.com, you get the stuff emailed to you every Thursday morning. We're really proud of it. I think you'll find it very valuable. Anyway, so Marcus and Millichap report. If I can get my my cursor on it. There we go. Okay, unemployment, job growth tempers in September. Industrial sector continues to outperform. Good job, industrial sector. Matt, what's going on?
A lot of even industrial, as everyone's talking about the shift to buying goods, and we talked about this for the past year. But the immediate news is that the jobs report came last week, and jobs are not being added at as fast of a rate as expected. It wasn't catastrophic, but it wasn't the picture of economic recovery that was anticipated. Some of this may be a record of last month's effects of the now waning surge of the Delta variant. But this report, like you mentioned earlier, suggests that maybe vaccine requirements are an additional obstacle that's slowing down the hiring and onboarding process, and potentially, it's just one more barrier to getting people up and running.
Yeah.
I think that one thing that's interesting and directly maybe ties into what we're talking about with inflation is that they said the average hourly earnings increased 4.6% year over year in September, well above rates recorded before the health crisis. The added labor costs paired with material shortage and inflating fuel prices are raising the bottom line for many companies, and the change may impact future decisions regarding space requirements as leases come up for renewal. But this well above rates recorded before the health crisis, that's a little bit of a small red flag, but nevertheless something that we should kind of be looking for when we're talking about this recursive effect between wages, inflation, and prices.
Well, and we all would like to see wages rise, but all of a sudden, if they rise too much, then all of a sudden that increases the cost of goods, and it potentially just that's where we can possibly get into that inflationary spiral. Absolutely fascinating. Okay, so Globe Street did a similar article on this topic, what the return to the office will look like. Of course, Matt and I are here saying like we've been in the office for over a year. You may not realize that since we're doing this on Zoom. It's because it's the easiest way for us to produce this show. Matt's in 2 offices down from me. Knock, knock, Matt. But what's the return of the office going to look like for people who aren't back at the office for whatever reason?
Now, more than the Marcus and Millichap article, this Globe Street article, which is really actually kind of summarizing a JLL webinar on activity and office usage. JLL found a majority of workers. JLL found that activity and office workplace activity, peaked in July, and then it retracted a little bit in the last 2 months, which to me I think suggests that it kind of tracks with the Delta variant, a lot more than maybe was anticipated. But still, I think that we have hit the low, and then we're on the way up. Again, office real estate is not a magic barometer for economic forecasting, but it's hard for me not to draw the parallel between the conditions that facilitate a return to the office and the conditions that facilitate a fuller economic recovery more general. I think that the office is not the shipping port or the trucking industry, but I don't think it's an outlandish hope to look for more activity in those areas as the Delta variant of COVID becomes less prevalent.
Yeah.
So that's my optimism, is that maybe it is transient. Maybe think people will come back to work, especially in the logistics industry. I'm just hoping that the waning effects of Delta really start to help the economy build a head of steam, and that we're not kind of going on a treadmill here.
Yeah. And I'm also just thinking about, all the, the central business districts, the downtowns that have just been, suffering, and they're definitely doing better than they were 12 months ago. But, just think about all the ancillary. Just think about all the ancillary businesses that are associated with, downtowns, and whether it's restaurants or small stores, and without these daytime populations are just struggling. And, we're looking at, there's, some apartments that we're looking at in downtown areas, and we're just not as confident, because it's a different environment than it was. And even in the discounts are there compared to suburban assets on a cap rate basis, but not enough discount where it really gets you very comfortable. Now I could make a call, which I'm not really ready to make, because I just don't know, of like, hey, we're at the bottom, and buy low, because we're going to see some kind of recovery at some point. Maybe it's just taking longer than we thought. And so getting in some of these, high quality downtown assets, now there's a great opportunity to do that. Just like last year in New York City, when there was huge fire sales going on, it would have been a good opportunity to buy probably some of those assets if that's a market you're comfortable in. So just a
and that's another thing too, is are people calculating that we're not going to ever return to work? Because JLL, in part of the information that they gathered, also found that there were a majority of workers that were dissatisfied in some way or another with a remote working experience. And that kind of jibes well with me, especially if it's hybrid work, where you're kind of always chained to the conditions of whoever is the most remote. So you may be in the office together and doing what could have been an in-person meeting because one member is remote. It just makes things less efficient than if you're all in the room together.
Yeah, it's definitely too. I mean, there's some things where it's like, we can just knock this out at home. But I mean, I know and I have to ask myself, are we just coming into the office just to come into the office? But like our meetings would be as effective if we were doing them all remote. I mean, correct me if I'm wrong. I mean, sometimes we could do them remotely, but I mean, like the meeting we were doing earlier today when we were going over, the marketing plan for new opportunities that's going to be coming out soon. We could have done that remote, but like it wouldn't have been as effective, I think. I mean, Alex is remote, so she called in, but I don't know. It's hard to, can't get up on the whiteboard, and I don't know.
If you're in the same room, you don't have to call. There's these little gaps and these small opportunities. And they're also saying, like, when it comes to advancement, it's always the person that's going to be in the office that is going to be better noticed than maybe someone that you've never seen your superiors face to face. And there is a lot of there's a lot.
And how do you build culture? And I've heard this multiple times of some new college graduates, and they've been working at a job and they've never met any of their coworkers ever, or their boss, or anybody. I think for a small percentage of your workforce, virtual assistants that aren't the same type of team member. Okay, but how do you build culture? How do you build teams? And I don't know. It's hard to do. I think it's possible. Absolutely, businesses are doing it all the time, but maybe it's a style thing. Maybe it's preference. I don't know, but.
Yeah.
Okay. U.S. apartment construction remains substantial, much needed supply. At least they're talking about building. They're making plans to build. This is from RealPage, Greg Willett. A lot of good stuff, per usual, from the folks at RealPage. Matt, what's going on? Construction pipelines.
Yeah. So and again, this is not counting completion, but going into the final quarter of the year, ongoing construction of market rate apartments stands at just over 650,000 units, which is roughly the same amount of activity as the past 2 years, but still not enough to meet current housing demand. I think that the fact that we're building, and again, this 650 number is ongoing. It's ongoing construction is remarkable, and this is important because everything we've heard about that supply chain says that developers are having a harder time building with a smaller labor force, higher cost of materials. And I don't know if you watched lumber had a huge big spike this week, and not to mention delays that hurt progress. Even so, They are continuing to build, and developers are able to justify the higher costs and delays associated with building in this economic environment because they're confident that they will be able to make a profit. And we have one just next to us. These aren't empty construction lots. These people are active and at work because they're seeing the same fundamentals and the same burgeoning and unmet housing demand that multifamily investors are seeing, or really even build to rent investors and all these. The housing market is just insane right now, and it is making it so that it makes sense, even despite the shipping containers that are lined up outside of all the ports. We're building through it, which is it's remarkable to say the least.
So it looks like DFW, Dallas Fort Worth, staying on top. A lot of construction. 38,000 market rate apartments are under construction in Dallas. That's a lot. That's a lot. Also, the Gateway metro story looks like a ton of apartments are being built in these gateway markets. The Washington, D.C., New York, LA, you can see them, New Jersey, Seattle, Boston, Chicago, Oakland, San Jose, San Francisco. It's a lot of apartments in those markets that have been relatively soft. Again, that's just where, it's where the money is. That's where a lot of wealth is. People like to invest in what they know. And some of those markets, I think you're going to see some softness because of that oversupply.
And that's something that we've talked about too. And I do think it is particularly interested, is when you're looking at a market, or when the national numbers only tell part of the story, and there could be markets that are hurting for supply, but developers just haven't chosen to build there.
Yep. And again, specifically in terms of a lot of construction, again, a trio vulnerable to overheating, talking about Phoenix, Austin, and Nashville. Very, very hot markets. You can easily make the argument that they've got so much growth, they can grow their way out of it. Obviously, that's what developers, investors are basing their investment thesis on. But there's definitely that risk of oversupply, because it may just be a short-term thing, but you have to prepare, for
it's
conditions.
And that's something that we mentioned, I think last week, is it's interesting tracking the progress of these cities that are sources of maybe some of the migration from LA. I know I spoke with someone whose brother lives in Phoenix and said that everyone he talks to are either from the Bay Area or LA. And there are these key cities, it seems like, that have really significantly benefited from that out migration of gateways.
Without a doubt, with Boise, I think, being the craziest example. Elsewhere in the Sun Belt, the Mountain Desert region, Houston, Atlanta, Denver, Orlando, Charlotte, Raleigh, Miami, Salt Lake City, all seeing some pretty nice level of activity. 24,000 in Houston, 21,000 in Atlanta. Again, that's a lot. It's a lot of people moving there. It's a lot of new units. I mean, again, compared to some Midwest markets that have great growth, but it's like there's not even a fraction. It's like you're going to see prices go up. But we need some more activity in some of these Midwest markets. A little bit on Philly, Philadelphia's apartments rising pretty significantly. Small markets to watch, especially Huntsville. They have a big percentage of inventory coming online. Huntsville, 16.5% inventory growth rate right now is under construction. That's so they're adding significant amount of new units. Charlotte, Charleston, not Charlotte, Charleston, South Carolina, 8%. That's high, but it's nothing compared to Huntsville, it's 16%. And then Reno and Boise. Boise, that's the one market that really could use some more units with the amount of migration. And then again, they meant Huntsville is pretty insane.
And again, like you said last week, is it's hard to say whether this is going to lead, whether this is the overheating that RealPage has mentioned, or whether these cities are truly growing and kind of transforming into something bigger than they used to. And it's if they have the people that'll fill them, then who's to say that all of that 16.5% of growth is unwarranted.
Fascinating stuff, man.
All
right, so Matt, What is there one thing out of this week, out of all the report that was kind of surprising to you? That was in the newsletter, something that you came across this week, kind of note.
You know what it was? I think it was the story of The Office. The return of The Office was, I think, particularly interesting because for the past few months we've been hearing about like the stagnation of it, and I think it was hopeful, and it made me more optimistic to talk about people returning rather than the kind of lengthy and laggard performance of The Office, which I think does parallel a lot of the labor shortages, employment, and just the slower activity that we don't like to see. So that's just something that I'm following and I'll keep an eye on. I'm in the office now though, so hopefully more people will come in and the downtown will be more crowded than it has been.
That'd be good. That'd be, it's getting better though. It's definitely improved, and people are out and about. Man, I was at a restaurant yesterday. It wasn't downtown, but packed. A lot of the restaurants, so many of the restaurants I find are packed these days, even and they're at full capacity. So, Matt, outside of the newsletter, so you can sign up for graycapitalllc.com/newsletter. If I wanted to see what was going on in the multifamily industry right now, is there one website that will just I want to see all the intelligence, everything that's coming out? What would you say? Any recommendations?
I just go right over to grayreport.com, and it's got everything. It's got updated daily with the latest reports and multifamily intelligence, opinions, research, statistics. We've got it all there. Videos, podcasts. We gather it every day, and it's a large part informs the weekly newsletters. So if you want, some of these articles will come by, and I'll find one, and you'll get a head start on the people that are waiting until Thursday.
Matt, this is a lot of information. You almost need the newsletter to filter through, because there's a lot of stuff that comes out. But if you do both, you will be informed. You'll have the knowledge to make the right decisions and take the right action. I mean, here we got the Real Page Report on the headline right now. Great stuff. Very cool. And of course, you can take the next step if you're like, okay, I need to get in touch with these guys. I want to invest in some multifamily apartments. If you are an accredited investor, we'd love to have a conversation with you. You can hop on over to the Gray Capital website, graycapitalllc.com. If you'd like to join the Gray Capital Investment Club, complete your profile to get access to the Gray Capital Investment platform and portal, which, new opportunities pop up there, periodically as soon as we've got an incredible opportunity for you. So I would highly recommend it, graycapitalllc.com. to join the Gray Capital Investment Club. One other thing, Matt, I've got to mention. Got some cool things that came in today. So we made these Yeti. We got these Yeti handy mugs, tumblers, thermos. It's not thermos. Is it thermi or thermoses?
I don't think it's thermi.
Yeah, probably not. Yeah. Yeah. Anyway, so for our investors and our partners who invested in Suncrest Apartments, which was our latest opportunity that we just closed on a couple of weeks ago, everybody got one of these awesome little Yeti tumblers. Everybody else got a hat, a Suncrest and Gray Capital hat. It's the least we can do. It's a token of our appreciation. It's also just it's not even that. It's more of we want something to kind of mark the occasion, mark the event, and something to remember the process. Obviously, it's an ongoing project, but something that we want our investors to hey, I've invested in an incredible multifamily apartment community, and keeps your beverages warm or cold.
Yeah.
So, and there's rumors that a couple more Gray Capital projects are in the queue, at least one, another one possibly, and then maybe another two. We'll see what happens before the end of the year. We're going to have at least one other project, again, maybe two, maybe three. We're doing cool gifts. We've got cool door prizes for investing. So if you want to invest $50,000, you get a mug or a hat, which is pretty cool. I'm not saying make the investment just for the mug or the hat, but it's a great thing to have as well. I don't think people are just viewing their investment as investing in one of these, but I don't think it's a bad investment because these are limited edition. And Matt, I may be giving away too much, but these are going to become vintage pieces, highly desirable.
Yeah.
You know
That's
why?
true.
We are going to be going through a little bit of a rebrand here at Gray Capital, including possibly a new logo. So having kind of the OG logo as swag is, I'm not saying it's going to be like NFT craze, but I'm not saying it's not either. So
It's going to be a while until we do like throwback
we don't even,
merchandise. So that's at least a couple years.
That's like a
before it starts
decade.
getting
That's
like
a decade
vintage
out.
feel. Yeah. Yeah.
Maybe we should do Gray Capital NFTs, apartment Gray Capital NFTs that we give out to all of our investors.
That's fine with me. We'll make the.
Maybe we can. Maybe I didn't say. I think this would be cool. You know, could your membership, your ownership, your membership in the project link to an NFT, all of your rights in the NFT smart contract? Is that how it works? Kind of cool.
As a bonus.
Well, I think we could just do it as a bonus, but then in the next step, you know. Anyway, so we. I was gonna say digress. I don't know. I think we got run something. Anyway, Matt, again, great newsletter. The Gray Report newsletter comes out every Thursday morning at 8:30. So make sure you are signed up. And again, if you haven't given this video a like, and you're still watching this video because this is at the end and we've been going on for a couple minutes, I think you should have turned the video off. But if you have not, give us a like, subscribe to the Gray Capital YouTube channel, leave us a comment, shoot us an email and say, I watched this whole damn video to the end. What was I doing? But I was so informed. Giving you guys an extra 2 minutes was worth it. And here's a like, subscription, and a comment. They call it the hat trick. Okay, Matt, thanks again. Have a great week. We'll be back next Thursday morning and staying up to date throughout the week at thegrayreport.com. All right.